Welcome to part 2 of the lesson on international flow of funds and foreign exchange. The theory of purchasing power parity suggests that the price of goods should be the same in all countries if converted to local currency. The Triple P theory is based on the law of one price that states that identical goods should sell for the same price in different countries according to local currencies. The cost of a Ford pickup in the US and here in the Philippines, therefore, will be approximately be the same. This eliminates any possibility of arbitrage, which is buying goods in a lower price market and selling them in a higher price market to make profits. An example of arbitrage is when the price of products such as watermelons are cheaper in the Philippines than in the US. Arbitrage occurs when businesses will see the opportunity to purchase watermelons from the Philippines to sell in the US to make profit. However, this will soon result to parity based on the Triple P theory, as the price of watermelons will go up in the Philippines due to increase in demand, and then the US price will fall because of the increase in supply. The application of the Triple P theory can be seen in the Big Mac Index, a popular measure of purchasing power developed by The Economist magazine. The commodity used as the basis for the purchasing power parity is the McDonald's Big Mac. It shows the price of a Big Mac in different countries. The index compares the price of one unit of the Big Mac sandwich in different countries. The base price is in the US dollar since it is the widely used currency in the world. This is a sample of the Big Mac Index. The US base price is $5.66 per Big Mac. We can see that $5 is not enough to buy a Big Mac in Switzerland. So the purchasing power of the dollar is low in that country. The Swiss currency is overvalued relative to the US dollar. In Singapore, your $5 can buy approximately 1.25 of a Big Mac. So the dollar goes a long way in Singapore. This means the Singapore currency is undervalued relative to the US dollar. The purchasing power parity is not always true. Parity appears to hold in the long run for periods exceeding 5 years, but may not hold in shorter periods, meaning parity tends to occur after a long period of time when businesses are able to adjust to changes in cost. In the short run, prices tend to vary. Imagine the rise of transportation costs. This has an immediate effect on price, and businesses can immediately increase the price of a product in places where transportation goes up. Parity can occur in the long run after other places realize, for example, that they should raise their prices too since demand for their goods has increased and since consumers were attracted to the lower price. Also, parity normally occurs in countries with almost similar inflation rates, and the theory does not totally explain changes in foreign exchange rates. Triple P theory predictions are affected by transportation costs and trade barriers, that is, tariff differences between countries can cause price differences. Government intervention in trade and exchange rates. The exchange rates and government regulations between countries can cause price differences. Multinational firms with pricing power. Powerful companies can set different prices for their product in different countries. Market expectations about economic factors. In other words, speculation about the performance of a country can affect the price of products. Goods not traded but that affect internal prices. Examples are rental fees or service fees in the countries. Inflation can affect foreign exchange. The change in prices in countries can therefore influence the rise and fall of foreign exchange rates. Take, for example, the US dollar and the Philippine peso exchange rate. If prices rise in the Philippines, this depreciates the value of the peso relative to the dollar, and consequently, the US dollar will appreciate. When purchasing foreign currency, therefore, it is crucial to determine the accurate and fair foreign exchange rate, especially when entering into forward contracts. Expecting payment in foreign currency at a future date might compromise its value, so it is important to compute for the forward exchange rate. This is the forward exchange rate formula for changes in inflation rate. Let's take this simple problem. Given that $1.40 per euro and inflation rate in the US is 10% and inflation rate in Europe is at 0%, how much will the dollar exchange rate be relative to the euro after a year? By substituting the given to the formula, we get the answer $1.54 as the forward rate of future dollar per euro exchange rate. Note that the spot rate is in the domestic currency and the home inflation rate is the domestic inflation rate. Now, given the same problem, note that the textbook uses a different approach with this formula. This formula proves the parity of purchasing power of the dollar and the euro. It computes the percentage change of the euro by finding P, which is the forward premium. So simple algebra will give us P at 10%, the percentage change in the value of the currencies. This is also equivalent to 10% dollar depreciation or 10% euro appreciation. It will still give us the same forward rate when applied to the spot rate. Here is another example of finding the forward rate based on changes in inflation rate. Note that the spot rate is in the domestic currency and the home inflation rate is the domestic inflation rate. Interest rate parity. In simple terms, this is a condition wherein the interest earned when investing in a currency of a foreign country will be the same as if you have invested in your home country, because the change in the foreign exchange rates will cancel out any earnings in interests. Interest rates can affect foreign exchange. The interest rates in countries can therefore influence the rise and fall of foreign exchange rates. Take, for example, the US dollar and the Philippine peso exchange rates. If interest rates rise in the Philippines, this appreciates the value of the peso relative to the dollar, and consequently the US dollar will depreciate. When purchasing foreign currency, therefore, it is crucial to determine the correct future exchange rate, especially when investing in foreign currency. Expected returns at a future date when investing in foreign currency might compromise its value, so it is important to compute for the forward exchange rate. This is a forward exchange rate formula based on interest rates. Here is an example. Given that $1.40 per euro and the treasury bond rate in the US is at 4% and similar bond rates in Europe is at 6%, what should be the forward rate? By substituting the given into the formula, we can now compute, which will give us a forward rate of $1.37. Interest rate parity will discourage any arbitrage. This is borrowing at a lower interest rate and investing in another currency that offers a much higher interest rate. As seen with this example, the investor attempts to earn more is cancelled out because of the rise in the exchange rate. The investor wishes to earn a 5% differential between the interest rate in the US and Malaysia. Malaysia gives a higher interest rate, so he might earn 3.2 million ringgits after paying out the $1 million loan including 7% interest. Using the formula, our forward rate is 66.99 Malaysian ringgit per US dollar. So the investor has to pay the total US loan at this rate. The value of the loan is now higher because of the higher exchange rate. This erases any possibility of making a profit. So simply, similar to purchasing power parity, except with money as the commodity, one cannot buy money at a lower rate and resell it at a higher rate. There is no arbitrage as fluctuation in foreign exchange will cancel out earnings. Given the previous problem, note that the textbook explains IRP with this formula. This formula proves the parity of interest rates of the dollar and euro, meaning that changes in interest rates will affect the foreign exchange rate so that they remain similar in value. To illustrate the parity using the same example, we arrive with the same interest rates. Here's another example of computing the forward rate based on interest rate. An Indian businessman has 63,000 rupees with him. Interest rate offered in the US is 6%, while in India, interest rate offered is 10%. What is the forward rate if the spot rate today is 63 rupees per $1? The forward rate is 65.33 rupees. In finance, you will encounter two kinds of interest rate parity: covered IRP and uncovered IRP. Covered interest rate parity involves using forward contracts to cover the exchange rate. A forward contract is used to hedge against exposure to exchange rate risk. When a formal forward contract is entered, interest rate parity is said to be covered. Meanwhile, uncovered interest rate parity involves no contract and sees only forecasting rates. So there are no forward rate contracts, and it uses only the expected or the future spot rate. Interest rate parity is said to be uncovered when investors see little risk in changes in foreign exchange, so no contract is used. Interest rate parity is not always achieved because there are many factors affecting interest rates, such as transaction fees. Transaction charges can be high or low depending on the country or the kind of investment, a country's social and political situation, how trading and investment is regulated, or how national currencies is governed in a country can make some investments seem profitable than others. Herd mentality, the tendency to follow the crowd, can cause interest rates for certain investments to go up. Also, central banks can implement interest rates which make investing in a particular country attractive or not. In order to forecast exchange rates, the most common method would be to use the formula based on the interest rate parity. This requires finding P, or the forward premium, which in turn require knowing the forward rate. The book also presents a method using multiple regression, which finds an equation for best fit. This equation takes into account several variables that can affect the future exchange rates. Variables such as difference in inflation rates, difference in interest rates, and difference in GDP. A model is then derived to be used for forecasting. Multiple regression can be solved using computer programs. Let us use the first method for forecasting in this example. What is the future exchange rate of the Philippine peso to the US dollar if spot rate is at 52 pesos per $1? Inflation rate in the Philippines is at 4.2%, while inflation in the US is at 2.24%. Assuming we are given a forward rate of 53 pesos per dollar, we can solve for P, or the premium rate, and then solve for the forecast rate. As a reminder, do take note of the following terminologies in this chapter. You have reached the end of our lesson. Thank you for listening and have a nice day.